Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Monday, the 22nd of June. I think this is the last Monday in the month. 30 days has September, April, June, and November. Yes, this is the last Monday of June. Dan, Nathan, back from vacation. I didn't dox you once. That's what they call that, right?
Well, by the way, you did, because I listened to the Fridays on the Tape podcast, and you said, Dan's in Paris. I hope I'm not doxing him. What did you think? I wasn't going to listen to the podcast while I'm gone?
So I did dox you. Well, I'm sorry about that. I'm not really sorry. By the way, you just heard the teaser for this, where risk meets opportunity. I was just telling Dan before this show that yesterday, one of my sons, my daughter, my wife, and I watched the remake of Point Break, which I think was made in 2015, and Laird Hamilton makes a bit of a cameo. Big Laird Hamilton fan. I mentioned that because he does a lot of those where risk meets opportunity commercials. Anyway, Dan is back. Just the two of us, as benign as the day might appear through the lens of the S&P 500, which is we're sitting here is up about 8 handles, which is, insignificant in the context of a $5,500 item. There are a lot of strange things happening. You obviously have a Dow that's up almost 0.75%. It was up more than that at one point. And you have a NASDAQ down 0.5%. A VIX that's effectively unchanged. So, man, oh man, a lot of moving parts. We're going to talk about those things. So let's throw up the old rundown, as they say, Dan. Time keeps on slipping. For you Steve Miller fans, by the way, Steve Miller from Wisconsin, I believe, the home of Elizabeth Young, no longer Elizabeth Young. So we'll talk about that. Great rotations, not to be confused with obviously the Dickens Great Expectations, although hopefully you all have expectations for today's show. Semi-bad day. That's Amanda, man, just killing it. And yeah, we'll take a little audience Q&A if we have time. So let's get right into it. Welcome back.
It's great to be back. By the way, Steve Miller went to high school in Dallas, Texas. He went to the
Sure he did.
School. The reason I know that is because my wife went to the sister school of St. Mark's, by the way, and he's one of the more famous graduates of that fine institution. Well, Guy, you just said things are a bit strange, and I think we have to, kind of stop and start with one stock that just as of last week took the mantle of the largest market cap in the world. It had it for like a day. That would be Nvidia, right? And so it's down 5.25%. At one point, it was down 6%. And what's interesting about this is, like, you and I were talking this morning, right around the opening, it was only indicated down 2%. The fact that it's kind of caught some steam, throughout the day, maybe Jacob could throw up a day chart, I think is pretty interesting, right? So it's taking the semi-complex with it. But unless you're just looking at the semis, there's a lot of green on my FactSet screen here, guys. So let's talk about that.
Let's throw up an Nvidia chart, and that's obviously today's price action. Okay, so that's that. Now, if we could sort of broaden it out and encompass sort of last week, where again, you were way on Halls, as they say. Good for you, which you deserve. And you saw Taylor Swift at all, but we had an engulfing pattern last week, the same type of engulfing pattern that we saw on March 8th. So if Jacob can just and now go back to March 8th, and I just want people to see what I'm talking about. So right there, you obviously, that day, the stock Nvidia made a new all-time high, closed on the lows, and the engulfing pattern is exactly what it sounds like. It engulfed the prior day market action. Okay. And, the stock traded sideways for a period of time and then sort of fell out of bed into the middle of April. And when I say fell out of bed, I mean, it's not like it went down 50%, but I think at one point the stock was down about 23% or so, obviously then saw the bounce. Okay. Let's go then to last week. And the same type of pattern, if you go through exactly, Jacob's going to go over a little bit more, a little bit more, a little bit more, a little bit more, and stop. So there you go. Stock made an all-time high on that day, basically closed on the low, engulfed the prior day's action, the same pattern that we saw on March 8th. It's pretty powerful for the technicians out there. And the sell-off obviously is taking place, at least in the short term, a lot sooner than it did then. So I just wanted to put it in context. We have actually seen this before. And again, it's not to say it's not an indictment of the company, but at a certain point, I think this stock might have some ramifications for the broader market.
Well, the other thing is that it's got to take other names with it, right? So money's come out of here and it's gone right into financials. So maybe
energy,
kind of show what's moving today. And so that's all fine and good. So you just look at that right there. You see the XLK down there, down 1.5%, and you see everything else screaming here. XLE, you see Exxon, Chevron, up 3% each. So you're definitely seeing that rotation. Guy, I want to bring it back to this though. If you think about Microsoft, if you think about Google, if you think about Amazon, you think about Meta, okay? So these are the biggest customers of Nvidia. And look at like just today, I see Microsoft's basically unchanged. Google is unchanged. Amazon is down 1% and Meta's up 1%. So one of the reasons why Nvidia and the rest of the semi complex are not taking down the broad market is that they haven't had their customers come with them yet, right? And so that
Mhm.
would be the next shoe to drop, if you will. And I want to go back to that March 8th period that you mentioned. Maybe Jacob can pull that up again. So it happened in the SMH too, right? And then the
Yes, it did.
SMH
Mhm.
after that, it kind of consolidated for a while, right? It retested those prior highs. It didn't make a new high, but then as the market started to sell off, it basically was down 23% on an S&P that was down 6% from its highs. That's the most important point, I guess, we'd want to make here, Guy. And then if you think about how much the stock has gained since it recovered in the lows in April, look, there's the SMH, and we know that this is the largest holding here. I mean, so that's the thing. If it really got ahead of steam, Guy, and it started taking its customers with it, like that would be the problem for the market.
Oh, Paul, again, I'm sorry to do this to you
Toggling,
folks,
we're
but it's
toggling.
important. But go to Nvidia real quick. I mean, the stock probably rallied what 80% or so
Yeah,
ish
there it is right there.
from those April lows. I mean, that's a staggering, and that's obviously building on the moves that we saw prior to that. So it is a pretty staggering move, and I do think it's important to point it out. And again, I'm just pointing out the technicals, and it's easy to talk about this stuff, as I've said before, ex post facto. We're just trying to be in front of it the same way we tried to be in front of it in March. Now, with that said, it did take a period of time for that engulfing pattern to play out. And it wound up taking maybe a little over a month or so. Now it's seemingly happening a little bit quicker. Again, it's very hard to figure out how they're going to manifest themselves, but you can't discount it out of hand. And, you throw an S&P chart up real quick through the lens of the futures, and you'll see that, again, maybe some interesting things happening. Obviously, the S&P is higher today, but you have that little bit of a gap in the chart. You see it right there. I mean, we'll see. Do we get back down to the 50-day moving average? I say yes. Do we get down to the 200-day? I've thought yes for a while incorrectly, but you just have to wonder what the catalyst is going to be. And for at least in the short term, Dan, the semis are maybe the beginning of something.
Yeah, so it's interesting to look at this S&P chart. We've talked about a little of the data about those top 4 or 5 names, what percentage of the S&P. I think they're getting to about 30%. Does that sound right, Guy? And when you think about that, we've never really had that. And one of the things that I would say not too different, let's say, than from 24 years ago with the internet is that they're all going up for the same reason. They're all going up for their exposure to this transformative technology. Now, you could say that it's very different this time when you think about, Microsoft and Cisco and Yahoo and Qualcomm. Those were some of the biggest names, and GE was in there, having nothing to do with that. But the big tech names, at some point the fever is going to break, right? And then it just depends, like where do you buy these stocks on the way down? And I would say that obviously when Nvidia got down 20% in late April, that would have been a great time to start buying it. You know what I mean? But there's going to be a time where you buy it down 20%, it's going to be down 40% at some point. So again, the S&P guide, to your point about that breakout level, it was 5250 or so. We're at 5500 ish or something like that, just above that. A lot of strategists have been tracing those targets up all year long, right? As the stock market's been making highs. But I think it's interesting. Your point is that 5250 is that 50-day moving average. The 200-day moving average will probably be around 5,000, Guy, by the time, if you were to have like some correction down to the 50-day. And then at that point, you'd be down 10% in the S&P 500. Now, we've also quoted this data that the S&P has not had a 10% peak to trough decline. I want to say, I don't even think it did during SVB, Guy, in February of 2023. So it's been more than a year and a half or so, which seems like, that's got to be coming to a theater near you.
Yeah, I mean, the other thing, and we talked about this, what is it? What's the number now? 360 odd days of
377 days.
377. So think about that for a second. Trading days without a 2% close lower on the day, which is remarkable. And I want to say it is a record. There are a lot of records, by the way, being broken. And that's been fantastic. Again, it's been wonderful. But you have to say to yourself, man, oh man, it's just the better things get, Is it just mean the farther we have to fall? And obviously, I've thought that for a while incorrectly. Let's throw up a NASDAQ chart real quick in the futures. It's look very similar to what we're looking at here. However, if you do start to see this rollover, it's going to get pretty interesting. And you see where the moving average is. It's very similar, obviously, to the S&P chart. Now, the good news is, I guess, look at what happened back in October, November of 2023 when we traded down to it. I mean, we didn't stay there long, and the bounce was extraordinary. I thought in April, by the way, that we would trade down to it again. I looked really smart for a period of time, and then it obviously stopped short, and we're off to the races. So let's see how it all plays out. But those are the charts, obviously, we want to look at through the lens of futures today.
Yeah, no doubt. The NASDAQ futures, the E-minis here, 15.5% off those April lows. We know what was driving it. We just went through the Nvidia and how much that has gained. Microsoft is the largest holding at about 8.5%, Apple 8.3%, Nvidia 8.2%, then it's Broadcom, and then it's Amazon, and again, and Meta right after that, and then Google. When you think about the concentration, again, like all of those names, are really associated with this generative AI trade. And so you have to just start thinking about, the pull forward in the stock market relative to the fundamentals, I think is a really interesting exercise here, people. You know what I mean? Like just one of those sorts of things, because putting your finger on the use cases right now, the monetization is just not there for anyone. And so again, Apple, which finally joined the party and skyrocketed 15% in a straight line in 2 days after WWDC, because they joined the party, they don't even have any of the models. You know what I mean? So like basically they're going to be an aggregator of those models. And your hope is, much like Dell, which is a tiny company relative to Apple with a $3 trillion market cap, but that you're hoping that there's going to be an upgrade cycle because of this technology. That was what a lot of late 99, 2000, that was the whole psychology in around this. Oh, the internet's going to cause an upgrade cycle in PCs. We didn't have smartphones back then. So again, I just think it's important to remember, Sun Microsystems, which made all the servers that made, powering the internet portals and all that e-commerce stuff and everything like that, which all those companies were unprofitable. Sun Microsystems sold up 85% from its all-time highs in 2000 to its lows in 2003.
And in large part due to, the CEO and the founder of the company basically laying out just how implausible it was for the growth vis-a-vis the stock was for it to continue. And he basically showed the math around it. And I think he opened up a lot of people's eyes. I think that gentleman's name was Scott McNeely, if I'm not mistaken. So real quick, let's take a look at rates, because this is going to play into the next thing that I say. I mean, 10-year yields, Dan, have basically been sideways. We've moved up and down a little bit, but since you've left, here we are basically, let's just call it 4.25. But, it's interesting you talked about all those customers. Think about that for a second. I mean, whether you realize it or not, a lot, specifically Facebook, from other companies as well. I mean, they're pretty economically sensitive names. And if you think about the customer of Facebook, it's a lot of small and medium-sized businesses. And I mention that because if we were to start to see a slowdown, I mean, at some point it does manifest itself in Facebook, not only in the stock, but potentially their capex as well. So just keep all in mind, there is an economic aspect to this as well. So let's talk about the yields real quick.
Hold on. Before we do that, Guy, you just mentioned Facebook. Can we throw that Meta chart up for a second? I the fact that you just said capex, I think is really fascinating. So if you pull up this Meta chart, when they reported, I want to say a little more than a month ago, maybe it was a month and a half ago, there's this huge gap in the chart, right? The stock was down, I think, if you just look at it,
it was down 28%, I think, at one point.
Yeah,
I want to say, I might be wrong.
No, I think it was down like 20%, closed down. If you see that, it closed at the high of the day, Guy, and it was trading. I think it closed down 14 or 15%. Maybe it closed down 18% or so.
Anyway, yes, but I remember it being. I remember that I was flabbergasted by how low the stock went. I think it got down to I want to say 408 or something. Anyway, please continue. So
no, I mean the point there is that the guidance that the company gave, the quarter was a little better than expected. The guidance that they gave was just a little lower on revenue and a little higher on capex, and investors just shot that thing. You know what I mean? And now obviously it filled in the gap within a month or so, and now it's trading very near those all-time highs. I just think that was a very telling moment for me, Guy. And what do you think is going to happen if they do the exact same thing when they report in a month from now? You know what I mean? Like, do you think it's going to be better for them? I just don't, especially if like earnings estimates are not going up and then spending is going up. So that's my only 2 cents there.
No, it's fair. And I think look, I mean, all these things, with each passing quarter, one would think the economic impact of all the things that have been happening are going to, at some point, I'll use the word again, manifest themselves in the earnings and the subsequent guidance, because you're clearly seeing it in terms of some of the economic data that's out there. So we'll see. I mean, again, I'm not trying to be negative for the sake of being negative, but you just look at all these things and you're trying to create a bit of a narrative here. So that's yields. And I'll say again, if Jacob can do this real quick, if we could throw up a dollar yen chart, and I'm sorry to go off script a little bit here, but this has been something that obviously I've been watching, and I know it makes people's eyes glaze over. But now the fourth largest economy in the world, Japan, slightly smaller than Germany. They're effectively the same size, but they intervened in their currency back in April, and you saw when it traded up to 160, they got it. They were able to, through that intervention, probably get it down to about 152 and change. Since then, the trajectory upward has continued. And by the way, as wrong as I am about a lot of things, this is one that we've gotten right. We thought that would happen, and that's exactly what's happening. So here we are, once again at 160. That's in the face of them raising rates. So there's a lot to be concerned about. I only mentioned dollar yen, and then go back to rates real quick, because again, it does have impact on our bond market. Now, you've had a couple really good treasury auctions. I'll be the first to say it. I'm not really sure what that was on the back of, but when you look at Japan and what's going on there, at a certain point, I do think that has ramifications. And that's been one of my bear cases for bonds. In other words, why I think that yields will, continue to go higher, Dan.
Yeah. So let's talk about something else, though, for a second, as it relates to yields. Obviously, they've come off pretty significantly, about 0.5%, which is a huge move, right, on the 10-year, if you think about it. And, we've gone back and forth between whether good data in the economy, right, is good for the stock market. So what's clear to me is that the stock market has not been bothered by strong data. If anything, it's reflected itself into earnings growth that has materialized better than a lot of people would have expected coming in this year. And that's 2 years in a row now, Guy, that we're seeing that, right? And so when I think about that, great. When I think about jobs, we had the unemployment rate tick up to 4%, but they're still kind of coming in better than expected. And, the market has basically taken the inflation data and they've taken the jobs data, and they basically said, you know what, yields, which you guys were convinced, and I'm just saying this rhetorically, right, we're going to be higher for longer, versus the inflation rate, are not that restrictive, right? So the economy is maybe not doing as bad as some people think. And, you can be negative on the stock market and positive on the economy. You could basically say, especially where the stock market is right here and right now, if you just think about that, I mean, they're giving you 17% in the NASDAQ and 14.5% in the S&P, and you could have, data that continues to come in hot, and maybe rates don't move that much, but maybe it's good for the stock market. Maybe it's good for housing prices. That's all I'm saying. I mean, I kind of felt this way for a while, because if you're waiting for the data just to fall off a cliff, it doesn't seem like it's ready to do that, especially when you see some of the manufacturing data that's been out in the last couple of days. It's coming in better than expected, Guy.
You're definitely getting some cross currents. You're right. I mean, anecdotally, you've had some good data. I would say I want to be careful, because I haven't looked at everything in its entirety. But for me, just it seems like it's been more bad than good, with some good around the edges, without question. The biggest one that concerns me, and I think it's going to be front and center, obviously, into this debate and then subsequently into the election, is the unemployment rate. Now, again, I'm not suggesting 4% is problematic. That's not my point. But if you look under the surface, if you really break down the numbers, there's some things to be concerned about, without question. So, but I hear what you're saying, and neither one of us are economists, and I'm not going to try to play that. But one of my concerns all along has been, you're going to start to see a precipitous move higher in the unemployment rate, and that's something the stock market is probably not pricing in.
Right. And just to look at that chart right there, it's kind of interesting where it stopped to the penny, as our friend Carter Braxton Worth would say, Guy, and making a little bit of a consolidation there. So let's see what the data looks like, because if there was a bunch of strong data, you should see rates go back higher, right? Like, wouldn't that be the kind of knock-on effect? Really quickly, the CME Fed Funds Tracker, okay, this has been really pretty volatile over the last
Very volatile.
when you think about it, right? And so we don't really need to look at July, right? We see what's going on there. Not likely to see, but this is important. So this is December, and when you look at that large one in the middle there, that looks like a pretty normal distribution. That's saying that there's what, a 40-some% chance. What does it say? I can't read it that closely.
45.2.
All right, 45.2% chance that yields by December are down. This is the Fed funds by 50 basis points at the higher end. Okay, so talk to me about that. You see that, there's a probability of 20-some% that they're down, 0.75%, but then there's a 27% chance it's just one cut of 25. Thoughts here, because this is really, again, you could say this determines where the stock market's going to, it kind of doesn't in a way. Like, you know what I mean? Like, and I know Liz has been showing us all the data. It's like, it's not when they stop raising, it's when they start to cut.
Right.
The time you want to be careful in the
You
stock.
know, and it's interesting because if the first rate cut, and again, it suggests it will be in December. If that happens in December, I mean, the bulls will say, look, I mean, that's because things have been moving along elegantly, that nothing's broken, and we can sort of just now at the end of 2024, you go on this rate cutting cycle a lot later than people thought. But quite frankly, the market didn't really force our hand. And in not forcing their hand, something didn't break. Maybe it is positive for the stock market. I'm just trying to look at the bull case as well. Now, with that said, if you were to get a rate cut before that, it's probably because something happened. To your point about that rate cut might not be market supportive at all. And I think the market is saying December because, again, thinking about what's going on over the next few months into the election, they could say that they were not politically motivated, and regardless of whether or not they are or not, and I don't think that they are, by the way, but at least it gets you through the election. So, but there's enough here to piss off everybody in the room at the same time. I think basically what we're looking at is one rate cut by the end of the year, whether it's 25 or 50 basis points is yet to be determined, but it's almost like a foregone conclusion that something's going to happen in December 18th. Given that chart pattern right there.
Yeah, and some people feel that just because they were kind of late to the game on inflation in 2021, right, and they were just doing that whole bit about transitory, right, they're not going to make the same mistake, right? Well, they're actually they can get it both ways, right? If they get worried that they're being too restrictive for too long and they start to cut too early, and you made this point, then if you re-inflate, the inflation numbers that have been deflating, right, since the highs in 2022, then they got themselves a little bit of a problem. If they wait too long, though, then I don't know. I mean, it's a tough one here. You and I talked about this earlier. So with yields the way that they've come in, it is interesting that you've seen the U.S. dollar index, the Dixie, firm up over the last couple of weeks as yields have come down. And obviously, this has something maybe to do with the weakness in Japan. When you look at the Dixie and you look at what percentage of it is euro and the yen, I mean, that's kind of the majority of it here. How much of that is playing into this? And let me ask you this, Guy. If you were to see the Dixie go to that high end, okay, make a new high from those April highs and get the high end of this channel above 107, that's got to be some kind of impactful sort of situation as it relates to, U.S. companies that actually, the strength of the dollar, the multinationals could be an issue.
We've had Mike Kao on, and you should check out his Twitter account. Kao is the way you spell his last name, and and we've had other people on as well that talk about a strengthening dollar. Somewhat counterintuitively, obviously creates a lot of problems, and you're smart to bring it up. And obviously, the dollar's been rallying in the face of yields going lower, which again, maybe it's just an anomaly in the short term, but historically, obviously, that's breaking the norms. I'll say this as well, and because Doug Cass is hitting us, is something we alluded to as well. Bitcoin, and if you could pull up a real quick Bitcoin chart, Jacob, on the fly. Obviously, today's something happening. I cannot I'm not even going to try to pretend that I know what's happening, but what I've thought all along, that Bitcoin is effectively an overlay of Fed policy or Fed commentary, whatever it is. This move lower in Bitcoin to me suggests maybe the Fed is more hawkish than people think, because an overly aggressive Fed on sort of the accommodative side has been very supportive of Bitcoin, and a very hawkish Fed trying to pull on the reins and step on the brake has been very negative for Bitcoin. Something is happening here. I think that also is playing into what's going on with the dollar. There are a lot of moving parts, and to not bring up Bitcoin, and we were going to talk about it, I think it's all part and parcel of what's going on.
Yeah, I think that's interesting. I mean, a pillar of the bull case for Bitcoin had been, just the debasement of the dollar, and the dollar has been fairly firm. It was also meant to be an inflation hedge. And I don't know if you remember, but it was trading very poorly when inflation was at its highest. You know what I mean? Now it's come back, into favor as it became clear, or at least clear to many, that the Fed, the only path for them as far as rates as we got further in this year was going to be to cutting them, right? And so to your point about this kind of higher for longer narrative, that would be something that shouldn't be great for Bitcoin, because you're going to have a dollar that's stronger, right? And you're going to, so I don't know, it's a tough one. And again, I think that today's move shows you the illiquidity, that you can find in Bitcoin in general. I know the CME trades futures on Bitcoin. We had that great, remember that we had that futures challenge in the crypto that we got. A lot of our folks did it. We had hundreds of people do it alongside with us. The beauty about trading these in the futures market is you can set stops. You know what I mean? And like sometimes when you don't have a very liquid market, your stop can get elected. You could end up getting filled below that, but at least you're putting some parameters in. And Guy, I don't know about you, but this 60 level, 60,000 is kind of a big level. It did get below that in early May, but it quickly came back, and then it was on its ways to making new highs. But I think the break to the downside of that uptrend that's been in place since this thing was trading at 40,000, I think is important.
Look, I mean, as we're sitting here now, we just got a 59 and change handle. So yeah, I do think it's important as well. And if you look at this chart, the big move up to basically 73 and change, the subsequent sell-off, the subsequent move higher, the failure to get through those prior highs. I mean, just technically, that's somewhat problematic. We have seen moves of this magnitude before to the downside. It's not unprecedented. That trend line that we've drawn has clearly been violated. So that's something to watch. I mean, the moving average, which was last in play, I think, October of 2023, probably comes in a little bit north of 50,000, which sounds ridiculous. But again, we have seen moves like that before. I guess more important than that, though, is what does it mean? And that's really what, we're trying to address. Like, is it telling a story? Is it Bitcoin specific? Is it a risk off thing? Like, what's really going on here? And is it something that we should be concerned about in terms of other asset classes?
Yeah, no doubt. Well, we just did nerd gold. Let's do the real gold. This is the thing that has caught your fancy. Well, it's caught your fancy for decades here. Let's be honest. You've been
No
a gold
doubt.
buyer. And I'm looking at a long-term chart. It really is amazing, like the price appreciation and the long, like I think people kind of get bored of it because you've seen, I'm looking at like a 10-year chart. You see these long consolidations, and then you see these breakouts, and then you see a long consolidation,
Yep.
and then you see a breakout. It's a very stair-step sort of function. Well, here we are with a 1-year chart. You see that consolidation that we had, which, from the summer to the fall, once it got back on its horse a little bit, epic breakout. I mean, that's probably one of the biggest sort of, 2-month moves you've seen in gold in a very long time,
I
guys.
think a lot of people have seen, without question, you've seen a couple single day moves to the upside, and then obviously the subsequent back and fills. So, look, one of the reasons I will remain bullish gold is because of what's going on with central banks. I still think, going back to Japan, I think that could potentially be the epicenter of everything, and the bull thesis. If in fact what I think is happening there is happening, I think it plays well for gold, and something that Danny and I talked with Cameron about on Friday. So if you didn't listen to that, check it out for sure. So the sideways action is frustrating, but the sideways action is not unprecedented, and we've seen it, the consolidation, and then the next subsequent leg higher. And again, that's what I think we're setting up for. Now, if I'm wrong, again, I'll be the first person to say it, but that's what I think this price action suggests right now.
All right, we took some questions, or we
I got
fielded some questions, Guy.
Want me to throw them at you?
Yeah, let's do it. Let's
All
do
right,
it.
this is from Jack Nargunkar, who's with us every day. Jack, how are you? Serious question. Do Dan and Guy expect PCE to come in cooler than expected? I think 2.6 is what Jack is saying on Friday. So if I'm being, intellectually honest and consistent, I've thought inflation numbers would come in hot for a period of time. I've been right for a few different months. I've been wrong. The last 1, 2, I've probably been wrong, but I still think that inflation is a problem, and it's manifesting itself in all different ways. The cumulative impact of inflation is hurting a lot of people. If you look at shipping rates, they've actually started to turn higher again. So, yeah, my answer to you is, yeah, I think it's going to come in hotter than expected, and we'll see how the market reacts. That, by the way, is in the face of a couple numbers that have come in cooler than expected, and the market has reacted in kind, Dan.
Yeah, no, it's also interesting, and Jack, I appreciate the question. It's a tough one because let's just say you do have inflation readings that start to just pick up just a little bit. But let's say companies, once again, let's say consumer confidence continues to chug along. Let's say the unemployment rate doesn't move meaningfully above 4%, and companies get back to this kind of equilibrium where they've kind of dealt with some of the greater input costs, right, Guy, from inflation, that's been running hot for 2 years, well, for many years, well above that 2% target that the Fed has had. I mean, there is a way that this thing could just keep chugging along, and the S&P, as long as it's still being dragged up by like a handful of names, you say to yourself, well, that wealth effect is still in place. Maybe households are having dealing better with this inflationary environment the longer it is. The flip side of that is the longer it goes, it has a greater chance of kind of weakening the consumer. And we make this point all the time. 70% of our economy is consumer led. So like this is all very related. And I just think, to Guy's point, one number doesn't make an economy or make the market, but it is interesting to see how the markets react, both the stock and the bond market, to this sort of data, one at a time there.
Wavy McFly here every day. What do you guys think of oil and I'm sorry that I'm reading from my phone. What do you guys think of oil and gas equipment stocks like Schlumberger, Halliburton? I don't even know if it's called Schlumberger anymore. I think it's called SLB Corp. The oil and gas equipment sector seems to be so beat down and ripe for value picking and M&A. Well, I mean, obviously, and thank you for that. We continue to see news, hear news. Marathon Oil is the last one that we saw, obviously, and on the M&A front. Warren Buffett continues to add to his stake in Occidental Petroleum. I do think, and we've said this for a while, that if there were ever a rotation out of semiconductors and technology in the whole, they would find that money would find its way into energy. You're seeing glimpses of that today. So, yeah, I do think energy is attractive here. I've thought that on the way up. I've thought that on the way down. On the reacceleration higher, I'm going to stand by that. I mean, you can make a very cogent argument on valuation. Clearly, there's been M&A in the space. We've seen a number of different deals announced. Valuations, as I said, are reasonable. It just comes down to money flows. And the problem is, in a zero-sum world, if there's $100 to spend and 98 are going to semis, there's only 2 left to go somewhere, and it's not making its way into energy. Now, if you look at that real quick, and I believe that's the XLE, there is a downtrend in place since that high in early April. Jacob can draw the line. That downtrend has either been broken or about to be broken to the upside. So keep your eye on that, because, that downtrend has been pretty powerful. You have a series of lower highs and lower lows, and here we are right there, Dan, Nathan.
Yeah, it's funny. We're right there. And I look at that and I say, okay, well, crude finally, it kind of had that pretty substantial move. What is it, about 10% or so over the last couple of weeks? And this pattern, I would say I'd probably rather sell it than buy it, Guy.
Yeah, no, look, I get it.
I'm a believer in these kind of like trends, and listen, it bounced right off that 200-day ish. You know what I mean? Like, so this is trading, to your point, very technically. And I think without the rotation out of semis into, energy related names, if the semis weren't selling off, I think this thing would be like well below this 200 average. So that's just my 2 cents.
No, fair enough. And, Hugh Hadley asked a question about the TLT. I'll just address it. I think we did talk about the TLT vis-a-vis the bond market, Hugh. So I just want to make sure I give you a shout out. And then Jay is asking, can you ask the boys? This is actually directed at me. Dan has not talked about this. If it's time to capitulate on Carlyle Group, it's like playing 2-7 offsuit. Yeah, if you throw up a Carlyle chart, I think it went from 38 to 48, and I felt like a effing genius. And now it's basically given almost the entire move back. And here we are. I think if I haven't looked at it today, I think it's trading about $40 or thereabouts. So yeah, there we go. So you see the big move to the upside that we felt like, oh my God, something's happening here. And then you've seen the subsequent move lower. To a certain extent, I guess it makes sense. I mean, there's a lot of concerns about people in private equity in general, names like this in general. It's not going to be Carlyle specific necessarily. However, I will say this, and this is going to sound like home cooking. Pull up an IBM chart real quick, and there's a reason why I'm bringing this up. if you look at IBM was dead money for a long time. IBM obviously did that Red Hat deal, and do a longer term IBM chart just for shits and giggles here. And they overpaid for it, but they were finally sort of able to integrate. But look at the move over the last sort of year and a half or so. And, it's basically, I don't want to say it's all predicated on Gary Cohn, but, you could sort of draw a line in the sand when Gary started there. I want to say about 3-4 years ago, and then the subsequent move. I mention it because, once they started listening to him in a meaningful way, that's when the stock started to accelerate. And you say, well, what the hell does that have to do with Carlyle? Well, Harvey Schwartz is a Goldman guy as well. And he's one of these people that will figure it out. And he's been in the seat a little over a year. I think he's the right guy for the job. I don't think it's an easy job, but I think he will figure it out in terms of the stock the same way that Gary figured it out for IBM, Dan.
Yeah, no, that's a good, that makes some sense. Really quickly, if Jacob can pull up KKR and then APO, which is Apollo. It is interesting, Guy. There seems to be a bit of a bifurcation if you just look at how some of these private equity listed names are trading, and then pull up the Apollo really quickly. They're basically at all-time highs. And then I'm going to have you look at Blackstone, because that we've been talking about. Look at that. Like, that's a really weird consolidation if you think about it, Guy, over the last it seems like to be in a volatile consolidation. So again, that's one I think worth keeping an eye on for a breakout. And then the last one is Blackstone. When you think about just their exposure, to commercial real estate, BREIT and the like, I feel like we've been talking about that for 2 years, but that's also been in a consolidation, found a little support. It's 200-day moving average, but you can see that there's definitely some laggards in this space.
Without doubt. You brainstormed something about, I think it's 6 weeks now. I think today is week 6, if I'm not mistaken. And that, of course, is the market matrix. And people are starting to gravitate towards it in a pretty meaningful way. So each day after the close, anywhere from probably 5 to 10 minutes, you'll get effectively what we think are the most important stories of the day. And you can explain how it manifests itself into this AI generated podcast.
Yeah. What we're doing is throughout the day, I mean, Guy and I are often together, whether it be doing market call on the tape, OK Computer, or Fast Money. And we're basically sharing a bunch of the stories with between the two of us and our team that we think are the most impactful sort of things. They're not always things that we talk about on OK Computer or on the tape or market call, but they're things that we're reading that are helping inform us. So we will curate about 10 stories a day. We'll put them in like Perplexity or one of these large language models with a prompt to summarize them. And then we put them all together, and we have our main man Brunson, which is a AI generated voice, read them to you. And again, Guy and I, we like to listen at 1.5 times, speed. So if you have an 8-minute one, you can do the math, as Guy likes to say on that one. It's going to be short, quick, and get y'all up to speed. So go to your favorite podcast store, go to MRKT Matrix, follow it, rate it, review it, share it. It helps people find it.
Without question, it's been a lot of fun. It's great to have Dan back. I want to thank everybody for joining as always. By the way, Amanda on jury duty, helping us with all the programming and the rundowns and such. Jacob, Timmy, Hockman back in the studio. Everybody doing yeoman's work. Tomorrow, I believe we're back. And if I'm not mistaken, the great Carter Braxton Worth will be joining us.
Yeah, matter of fact. All right, Guy, we covered a lot of ground. That was fun. Thanks for the questions. We should try to do more questions. I think those are
without question. We will do more questions. We are definitely, we're listening to what you have to say, and we're trying our best here, folks. We are learning on the fly as well.
Yeah, fair enough. All right, see you tomorrow.
Later, people.